Well, good morning, everybody. I'd like to welcome you to our April 2024 version of Farm Office Live. We'd like to welcome you to today's program. Just a reminder of some of the topics that we'll have on to today's program. We'll be talking about the beginner farmer tax credit update. We'll be looking at the commercial activity tax. Some folks will need to be closing some accounts due to some of the changes that we've been talking about on Farm Office Live with the commercial activity tax. We had some questions about the taxation and reminder of the new way to look at the taxation of equipment trade-ins. And then we just recently had at the beginning of this week the release of our OSU fertilizer survey Q2 release. So we'll talk about that. And then there's a close deadline here for the dairy margin coverage program. So we're glad to have Jason on today to talk about the dairy margin coverage program. And then we'll go into a session on transferring operating assets to the next generation. And then our industry guest portion of today's program will be looking at trends in farm appraisals. Wanted to give you a quick snapshot. Again, just a reminder of our farm office team, and we'll be rotating speakers in and out of our programs as we go. But we have Barry Ward, Peggy Hall, Robert Moore, and Jeff Lewis, as well as Bruce Clevenger, myself, David Marison, Eric Rieger, Clint Schrader. And today we're very pleased to have Amanda Bennett, who's an extension educator in Miami County, on as a special guest, as well as Jason Harchu, field specialist in dairy management and precision livestock. And our industry specialist today, Tim Harpster from the accredited Rural Appraisal Consolidated. He's an appraiser out of Wapakoneta. So we're pleased to have Tim on our program later. Now, just as a reminder that if you would like to access today's slides, you can go to go.osu.edu/farm office live. Those slides again are at go.osu.edu/farm office live. And if you want to see the recording of today's program, maybe you can only stay for a portion of today's program, or if you want to rewatch it, know that it will be posted there later. And if we make reference to previous Farm Office Live webinars, know that you can access those recordings at this site as well. I know the slides are up there, and Jeff is working his magic behind the scenes. He's already put in the chat box that direct link, so you can hit that direct link in the chat box to download today's slides. Just as a reminder, as for housekeeping, as far as asking questions, which we encourage you to do, just remember to drop those into the Q&A feature on your panel for your Zoom toolbar. If you drop it in the Q&A box, we'll be able to look at those real time or answer the question after the speaker is done. Be watching for the chat box, because the chat box is where we'll put those direct links for more information based on what each of our presenters is presenting to you. So with that, I'm going to turn it quickly directly over to our first presenter, and that's going to be Eric Rieger. And Eric is going to give us an update on the ODA Beginner Farmer Tax Credit Program and look back 1 year later. So Eric, I'm going to turn it over to you.
Good morning, David, and thank you. Was asked to give a little bit of an update of the Ohio Department of Agriculture's Beginning Farmer Tax Credit Program. We are not ODA, but we work very closely in partnership with them, in particular on a couple of programs, pesticide recertification, but also a fairly new program called the Beginning Farmer Tax Credit Program, which was, there we go, which was really a bill by Mary Lightbody and Susan Manchester, a bipartisan bill in the Ohio Assembly, just for your review, that took effect January 1st of 23, and it grants a 3.99% Ohio income tax credit to landowners or asset owners who sell or lease assets to certified Ohio beginning farmers. Those assets might be breeding stock, they might be buildings or pig barns, they might be farmland, could even be equipment. So intermediate or long-term assets that get sold or leased to a beginning farmer. I'm going to speak to you from the context of OSU's Farm On course. And I'll talk a little bit more about that. The OSU had a four-pronged kind of approach to addressing this beginning farmer need, which the tax credit required a beginning farmer to take a farm financial management course. And so we had some on-campus options, some in-person options, but the Farm On course was this virtual program, or continues to be a 10-module kind of video on-demand self-paced course that has exercises and quizzes for students to work through on their own time, or beginning farmers to work through on their own time and receive the certificate. They get the tax credit for the cost of the course. In the case of Farm On, it's $300. Some of those modules that are discussed, or themes, topics, if you will, are listed on the screen, with heavy emphasis on farm accounting documents like the balance sheet, income statement, and cash flow projections, but also some legal and risk management modules in farm taxes and record keeping. So that is that's the Farm On kind of overview. We rolled out Farm On in April 1st, and I need to give credit to, I don't have that picture slide, folks, I apologize, but 7 other extension professionals who helped deliver this Farm On course. We rolled it out approximately a year ago. At present, we have 80 enrolled in that course with 25 course completers. And then there's the next level, and I'm going to show you a couple of those documents on my next slide, but the next level is for those completers to actually complete the Ohio Department of Ag beginning farmer application. There have been 13 beginning farmers have completed that application, as well as 3 asset transfers, totaling or encumbering, if you will, $55,000 of the allocated $10 million for the 5-year piece of legislation. So this legislation at present will sunset December 31st of 2028. So I highlight that in bold because I think there's some opportunities for the professionals that are on the call. If you would encourage beginning farmers and asset owners that this program exists for a beginning tax credit, I think there's some opportunities for continued use of this program and at a higher level. So just some quick data. In extension, we do kind of pre-course survey work as well as post-course impact. On the inbound, those 80 folks that were surveyed, 50% of them had a balance sheet. Only 26% of them had calculated an enterprise budget. And I was surprised to find out that over half of the folks who are taking the course are already leasing and or farming. And a pretty high percentage of those are in writing. So pre-course work or pre-course survey work, and on the post-course side, of 24 of those folks were interviewed, completed. We feel like the course is making some impact. Folks agreed or strongly agreed that they're more confident in their ability to manage farm finances. And 3 areas where folks responded extremely likely, if you think on a Likert scale of 1 to 5. So this would be like choosing the highest level, 5, that 88% said they're extremely likely to update their balance sheet, 79% to improve their accounting or production methods, and 75% would use the tax updates that were presented. And all the modules ranked very high, but those were some of the highest. And so when we talk about that program, going from getting course completers to the tax credit benefit, the people completing the program do need to go to Ohio Department of Ag's website, which is, I have a screenshot here, and there's drop-down menus for the applications. If you're a beginning farmer, need to fill out that 2-page application, very simple 2-page application, and provide your certificate and proof of enrollment, proof of completion. There's a little bit on cash flows and balance sheet, but overall a very simple application, not overwhelming for the beginning farmer. And then I'll leave you with the senior farmer, and I use that in quotes. It doesn't exactly have to be a senior farmer, but it's more likely to be a retiring or senior farmer. They also have a simple application. And if you look at section A, the first item on there is the collaborating beginning farmer. So before they even give their own senior farmer information, the application is asking for the beginning farmer that they are working with and beginning farmer who is certified. And then it goes into some what assets are transferred. But so that's kind of a very quick 5-slide update on the beginning farmer ODA beginning farmer program. I do need to say that the Farm On course qualifies Farm Service Agency direct farm loan participants to kind of check the box for completing a farm financial management course. And our intake survey is showing that about half of the folks that are taking the course are doing it because FSA has that requirement as well. So if you have any questions, you can throw questions in chat or Q&A and I'll answer them. Thanks for your time. I think I'll pass the baton to Jeff Lewis.
Eric, you do have one question maybe you want to address real quick is like by in writing, do you mean that they have a written lease? That was, thank you, Patricia, for asking that question, but having it.
Yeah, so in the intake survey, we ask if they already, if those 52% that already had those 52% of the 80 people in the course who are already farming, did they have a lease in writing? And 63% of them had a contract in writing. That's the question.
Thanks, Eric.
I think we encourage that in the course. We encourage that very heavily. Peggy does a nice job and Robert does a nice job in encouraging written agreements. Absolutely. And ODA requires them. So they won't, if you want to get the tax credit, you have to have a formal lease or a formal purchase agreement. So thanks.
All right. Thank you, Eric. And good morning, everyone. As David mentioned earlier, I will be going over a quick commercial activity tax update. And really the focus of this update is closing your accounts. So commercial activity tax for the previous tax year in 2023, you are subject to the commercial activity tax if you had taxable gross receipts greater than $150,000. Now, we had some legislation go through last year that changed the commercial activity tax, but it did not affect tax year 2023. So everything remains the same. If you have been filing in the previous few years, it's the same process. And just wanted to make note that for annual filers, the annual return is due this coming May 10th. And that's where you will find some extra information on that tax return, and we'll go over that in just a second. But just wanted to briefly review some of the changes that are coming to the commercial activity tax. And so for this tax year in 2024, only those with taxable gross receipts greater than $3 million will be subject to the commercial activity tax and must file a CAT return. Some additional changes are that there is no longer an annual minimum tax and that all filers will become quarterly filers. And then in 2025, that threshold, the taxable gross receipts threshold, increases to $6 million. So those with less than $6 million in taxable gross receipts will not be subject to the CAT tax. So if you are an annual or quarterly taxpayer and you have been filing your CAT returns, do you have to keep your CAT account? Well, if you anticipate having less than $3 million in taxable gross receipts for this tax year, you may cancel your CAT account immediately. And the Ohio Department of Taxation has said, please use an effective date of that cancellation to be December 31st, 2023. Now, this is a reminder that we still have to file a 2023 CAT return, even if you are canceling your account or you've already canceled your account. So how do you cancel your account? Well, there are 3 ways. And the first way, the easiest way, I think, is that there will be a checkbox added to the 2023 CAT tax return. So if a taxpayer checks that box on that return, their CAT account will be closed with an effective date of December 31st, 2023. So that checkbox is going to be on both this annual return that's coming up, and then I believe in February, the quarterly taxpayers also had the option on their last quarter return. The second way that you can cancel your CAT account is through the Ohio Business Gateway using the CAT cancel account transaction. Or third, you can submit a business account update form, which can be found on the Ohio Department of Taxation's website. Now, for those of you that have clientele, or if you're operating your own business, it's unclear whether or not this checkbox is also going to apply for tax year 2024. I would assume that it would. For those businesses that will be operating under the $6 million threshold for tax year 2025, but they operate above the $3 million threshold, they will still want to cancel their account next year, but it's unclear whether or not that checkbox is going to reappear. So what happens if you do not cancel your account? Well, all registered CAT taxpayers with active accounts are required to file returns, even if they do not meet the threshold. If a CAT taxpayer does not cancel their account and fails to file a return, they may receive delinquency notices and assessments. So it's important that we cancel the accounts, even if you aren't sure you're going to be above the threshold. You can always reapply, right? So if you're not sure if you're going to be above that $3 million threshold, cancel the accounts, and then you can register again if you need to. And for more information and more detailed information, I will drop this link in the webinar chat box. But the Department of Taxation has a great website that answers frequently asked questions, has a bunch of fact sheets about the CAT tax and the changes that are coming and have already been implemented. So if there are no questions, I will turn this over to David.
Thanks, Jeff. We've had a lot of questions with regards to the commercial activity tax, so we're going to keep watching that as those changes happen. Another area that we've had some questions is in the area of taxation of equipment trade-ins, because there was a change that happened a few years back that I think some producers may still not know that had happened, and it comes to some surprise when they go into trade into some equipment. So just to give quickly a little background on, and again, something that we're really watching because of a lot of these tax changes that happened under the Tax Cuts and Jobs Act of 2017, which was professed as one of the largest tax reforms since we had the tax reform of 1986 under President Ronald Reagan. But part of those tax changes included, of course, the higher estate tax limitations, which we have been watching here on Farm Office Live, as well as higher standard deductions for all taxpayers. But also there was a change in the like-kind exchanges, the Section 1031 exchanges for real and personal property. So back when this law was enacted, the Tax Cuts and Jobs Act, the real like-kind exchange for real property, such as land, was retained. However, it was eliminated for personal property like farm equipment and breeding heifers. So I think maybe it might be easier to talk a little bit more about this from the context of a couple examples. So here's an example. Let's say this is Amos Corn Grower. So in our tax schools, we like to use these weird names for producers, but this is Amos Corn Grower. He decides that he wants a new four-wheel drive tractor, and this tractor's list price is $397,000. So the dealer has agreed to take Amos's 5-year-old two-wheel drive tractor in for trade, and he gives Amos a $112,000 trade-in allowance, which then reduces the cash price to $285,000. So $397,000 minus $112,000. So however, on the backside, on the tax side, this two-wheel tractor that he traded in has a basis of $61,262. So if you did the depreciation on the backside, the tractor, this two-wheel tractor, two-wheel drive tractor, had an original cost of $250,000. The Amos has taken $188,738 of accumulated depreciation. So his existing basis, adjusted tax basis in this tractor that he's trading in, is $61,262. So in the old days, prior to the Tax Cuts and Job Act, this would have been a section 1031 tax-free like-kind exchange, and Amos would not have any taxable or reportable gain. Basically, you're kicking the can of the realization of gain down through history. So because there is no gain, what you would do is you would take the cash amount for the tractor, that $285,000, you would add the original tax basis, the remaining tax basis on the tractor that he traded in, you add those together, and then his new basis for depreciation to put on depreciation onto a depreciation schedule would have been $346,262. So could he use Section 179, could he use bonus depreciation, or put it on a general schedule? But that's what the new basis would be that Amos would follow. So under our new rules, so going past the Tax Cuts and Job Act, and this is kind of where we've been the last 5 years, the difference would be that he would look at this four-wheel drive tractor. The list price is $397,000. The dealer wants to take his new trade-in or his tractor and give him a $112,000 trade-in allowance. So when you look at that, the trade-in allowance, $112,000. Now you're looking at the tax basis of that tractor that was traded in was $61,262. So the taxable gain. So now essentially what's happening here is this becomes two separate transactions. So now his taxable gain, which would be reported on Form 4797 in Section 3 on Part 3, his taxable gain, which is an ordinary taxable gain, is $50,738. However, when he's buying this new tractor, remember the new tractor's cost is $397,000. So that doesn't change anything. The $397,000 now is reported on his depreciation schedule, or using some type of accelerated form at $397,000. So I have another example under the old rules. So this might be that new tractor cost. He's looking at a new tractor for $300,000. However, in this situation, this tractor that he is trading in is fully depreciated. So its tax value is $0. However, Amos is given a $200,000 trade-in allowance, which then would reduce the cash price or that boot to $100,000. So that $100,000 in the old day is what he would have put on his depreciation schedule. However, we know we're under new rules. So in the new rules, that tractor for trade-in that he has fully depreciated out, now his taxable gain is $200,000 on Part 3 on 4797. And again, because it's two separate transactions, then the new tractor cost of $300,000 would be then put on a depreciation schedule, again, at the full price of $300,000. So just two quick examples of some of these trade-ins. So what does Amos do? So now you have a taxable gain. So in these examples, examples 1 and example 2, on the first example, he had a taxable gain of just over $50,000. On example 2, he had a taxable gain of $200,000. Quite typically what will happen if they're worried about recognizing this taxable gain as ordinary income, then you can offset that using Section 179, provided, of course, that he's not under that, he's not outside of the limits of Section 179, or he could fully use bonus depreciation. So some of the warnings are some of the things to think about in these situations. Again, we would always recommend as you are doing some of these machinery trade-ins that you're meeting with your accountant and going over the tax implications that might occur because of the trade-in of this equipment. Now know that Amos could have an issue if he's already used his maximum Section 179 deduction, or maybe he's exceeded that investment limit. And just as a reminder, it's $1.22 million And then once it goes over $3.05 million, there's a dollar for dollar phase out. You may not want to use, so it may not be able to use Section 179, but also may not be able to use bonus depreciation too, because once you elect bonus depreciation, anything that you buy in that recovery class is going to be treated as bonus depreciation for that year. And just as a reminder, based on current, where we are currently, bonus depreciation is 60% for the year 2024. Understandably, there is a tax bill in Congress that's passed the House and is being reviewed in the Senate right now that's looking to alter some of these the bonus depreciation limits that are currently at 60%. And just know that Ohio state taxes are different than our federal side, that the ability to use bonus depreciation and Section 179 depreciation does have limitations when it comes to the Ohio side. And so just a quick reminder, we had some questions on this, just a quick reminder about the taxation of those trade-ins. So with that, I think I'm going to turn it over to Amanda. Amanda, we can't hear you. You're muted.
Sorry about that. All right, I'm excited to be here this morning to share with you all
That
some
was another
data.
issue, Amanda. I'm seeing the wrong screen. So.
Yes. Golly. Not this
But
also. Now can you see the right
It's
screen?
in recording. You're perfect now. Perfect.
Ah. All right. Well, I'm excited to share with you some data we've been collecting for the last 4 months or so with you here this morning. In December of 2023, OSU Extension launched a quarterly survey of fertilizer retailers in the state of Ohio. And our goal was to better understand local fertilizer prices in order to help farmers, retailers, and other professionals make management decisions. So retailers' contact information was provided by county educators or by an email request to the survey team. And the goal really was to stick with retailers that provided services in Ohio. So it was limited to those places. The survey is a Qualtrics survey in which respondents were asked to quote spot prices as of the first day of the quarter for 10 nutrients or products, and they only give prices for those they sell at the plant. And poultry litter was also included in the survey. We do realize that, many factors influence a company's spot price for fertilizer, including, not limited to though, availability, geography, volume, cost of freight, competition, and regulation. So the data is in aggregated, paying particular attention not to include any identifiers. And from there, a report is generated and published around the 15th day of the first month of the following quarter. The report is published on OSU Extension Ohio Ag Manager's blog, which can be found at the address on the top of the screen there, ohioagmanager.osu.edu. And Monday, we just released the findings of the second quarter survey, so we'll take a look at that next. This table shows the results from the second quarter survey. We list out the products on the left-hand side. We include a minimum and maximum price reported, as well as a simple average. In the middle of the chart, you'll notice the sale type is also reported. We have FOB sales types, which means freight on board sales types, which is a pickup at the plant in any quantity. And we also have direct to farm delivery, which would be truckloads. And lastly, we have delivered and applied within 25 miles for poultry litter only. So in our first survey, we had 23 retailers respond from 18 different counties. And in the second survey, responses increased to 32 retailers from 19 counties. So some of the highlights from the second quarter data revealed that in general, the average prices of fertilizer in Ohio are lower compared to national prices. And this was true for all the products except for DAP, which was about $5 more per ton in Ohio when compared to national prices. Now, when we took a look at comparing data from the first quarter survey to the second quarter, it was noted that most of the products increased in price, except for anhydrous ammonia, MAP, and ATS, which all experienced less than about a $5 per ton change from quarter one. And potash saw the most movement with a modest decrease from quarter one at $18 per ton less. 28% urea, DAP, and APP starter saw a modest increase. And DAP and urea both saw the most increase in price from the previous quarter, up about $50 per ton and $59 per ton, respectively. So the survey for the third quarter will be sent out via email on June 15th. If you know a retailer that might be interested, please consider emailing me at my email address here on the screen in order to get added to that survey. You can also visit ohioagmanager.osu.edu and subscribe to be notified when the quarter 3 data is released. And I want to thank my team, Eric Rieker, Field Specialist in Farm Management, and Clint Schrader, the Farm Business Analysis and Benchmarking Program Manager. So it's really a group effort. And with that, thank you, David, for letting me share.
Thanks, Amanda.
Well, hi everyone. Wanted to take a moment today to talk to you about the dairy margin coverage sign up. As soon as my little things on Zoom cooperate. But this program has been very beneficial to dairy producers. And we're underway on that sign up. Actually, we're rolling into the very end of that sign up period here for 2024. If you work with producers who have not signed up yet, they definitely need to get into that FSA office here shortly. And we'll go over kind of a recap and what's changed here moving into 2024 quickly, and what the program looks like here for this year. So the original production history for this program was set as the average of 2011, 2012, and 2013, looking at where that highest production year was. As we know, over the past 11 years, many dairy farms have expanded, whether that is just through increased milk production and the same number of cows, or through milking more cows. There was an option this year to lock in 5 years of coverage. In 2019, when this program started, for a 25% premium reduction, and many producers took advantage of that, as that lower premium made the program even more beneficial. And we'll talk here in a minute if they can still get that premium. There is a $100 administrative fee plus a premium each year, and that premium is going to be based on the level of coverage they select. And that tier 1 coverage is for anything under 5 million pounds, and then tier 2 over 5 million pounds. And we'll look here at the end at that tiering and those different coverage levels you may choose based on how much milk history you have. It covers that margin between the national all milk price, so it really has nothing to do with your own personal milk price, but that national all milk price, and then a ration formulated for dairy margin coverage insurance that includes the corn price, soybean meal price, and premium and supreme alfalfa hay price. A nice thing about this program is a good margin doesn't even have to be available on the board of trade in order for you to lock in that coverage level of 950, which is a fairly solid margin. And sometimes that is not even available. And then it is that 2-tier, and it covers 95% of your production history. A nice advantage of this program is you can still use other federal risk management strategies. While this program is administered through FSA, you can use the 2 programs that are administered through RMA, or the crop insurance side, which is dairy revenue protection and livestock gross margin insurance dairy. A quick look back at 2023. So 2023, the dairy margin coverage program was very beneficial to dairy farmers. And there's some important things to take note of as you plan for 24, both for managing your farm income and how this program may perform for you. So when we look back, we ended 2023 with an average all milk price of $20.47. When we look at 2024, we're only going to be slightly better than that, but there's some big differences. We don't have these lows in here. So our June and July lows, 1740 and 1790 there. No projections right now to be that low. But the other big difference between 23 and 24 comes in on the feed cost side. And if you're growing your own feed, this is definitely something you want to pay attention to. If your dairy farm really benefited from dairy margin coverage in 2023, there's not going to be quite as strong of benefit here in 24. So you're going to need to watch your costs. In 24, that average margin worked out, or in 23, that average margin worked out to $6.71 with a feed cost average of $13.76. And we look over here at corn price, until we get to here October through December, we're $5 plus for corn price going into this. And I know all of our grain farmers hope we get back to $5 plus, but currently that's not projected into the program. So when we look at 23, total payouts for a 5 million pound production history was $133,000, and the premium for that was $7,125. So there's really good returns in 23, and really the program overall has been very beneficial to dairy producers to sign up. So when we look at 24, 75% of farms enrolled in 23, and that's really expected to happen again, hopefully. Some things to think about as a producer or ask your clientele is if they enrolled in supplemental coverage in previous years, they can now combine that supplemental production history into a one-time base history adjustment. So supplemental production history, let them update that, and it was just a supplement on top of their history, and now that can be combined instead of being supplemental into their actual base production history, so it won't disappear in the future. The other nice thing is operations that enrolled in that multi-year 5-year lock-in in 2019, they still get that. If they opt in to the same level of coverage, they can still get that 25% reduction. The program's going to continue to keep the usage of 100% premium alfalfa hay instead of the 50-50 split between premium and supreme, which actually elevates that feed cost by using 100% premium. And the real important part here is you need to enroll at your local FSA office by April 29th. And there are payouts that basically as soon as that paperwork is processed and they can be issued for January and February if you enroll at that 950 coverage level. So what makes sense here for 2024? I mentioned, we're going to actually have a little bit higher all milk price, about $1 higher than 23. So 21.44 for that average. There's not projected for any sub $20 milk price, which is good. But of course, we're also projecting out. So, we're pretty solid on April, but as we get out further in the year, these projections are a little bit less stable as to where milk price and feed costs will really go. But you notice the much lower feed costs, about $3 lower on feed cost average, really opening that margin up and supporting a much higher margin than what we saw in 23. But that's my caution to our producers that are growing homegrown feeds is your real cost of growing those feeds may be very similar between 23 and 24. So you're definitely going to want to watch your own margins and manage those if your farm profitability somewhat came from the dairy margin coverage program last year. When we look at that margin forecast, January, we see that margin at 848 and 944 in February. So those are locked in. Those will have small payouts if you enroll at that 950 level. And then we're staying above that 950 margin for the rest of the year. April here does dip somewhat close. We'll have to see how we finish out the month of April. If we get strong corn price, that could change a lot. But as you look down through, while it's not projected for late in the year payouts, there's a lot of changes as we go through the growing season that are going to affect corn price, soybean meal price, and hay price just based off of weather. And then we have the unknowns in the dairy market as we deal with anything else that may pop up. But currently, for a 5 million pound farm, your premium would be covered about 60% of your premium if you had to pay and didn't have that 25% reduction. Would be covered with the January and February payout. So about $4,270 for a 5 million pound farm coming from January and February, and the total premiums $7,125. So, we're a little over half. It really looks like a strong investment to put that first 5 million pounds in at that 950 as a risk management tool. The goal should always be not to have to use our risk management tools, but we need them when they're there. So when we look historically at the program, every year except for 2014, if we look back to 2019, the program would have had a positive indemnity. It would have covered the cost of enrollment at that 950 margin for the first 5 million pounds, with an average net indemnity per hundredweight of $1.69. So it's working fairly well to support that first 5 million pounds. And when we look over 5 million pounds, decisions get a lot more difficult as to how much to enroll in. If we go back to that cost chart, the cost between the first 5 million and anything over that, so tier 1 and tier 2 coverage, start to split at the $5 level, and anything over $5 becomes much more expensive rapidly to cover anything more than a $5 margin. So when we look back for a 19 million pounds farm that had a 19 million pounds of coverage, we would be looking at the $5 level. Actually, every year was positive on that coverage except for 2014, very similar. If you enrolled your first 5 million at 950 and your second 5 million or second everything over that at $5. The average net indemnity there is only 58 cents because, of course, there's a lot more hundredweights we're marketing. But if we would jump that coverage to $6, we start to see a big divergence here in that covering that extra production at $6 with its added cost. $6 costs 31 cents per hundredweight for that production over 5 million pounds. And when we look 4 years since 2019 would not have been positive, and that average net indemnity drops to 47 cents. So there's probably better risk management strategies over that $5 coverage than the dairy margin coverage program. So things like looking at the futures and options market. Challenge there, of course, is large contracts. It requires a broker, requires, that margin account. But a nice positive is they can be bought and sold at any time. Where when we look at the two programs administered through RMA, Dairy Revenue Protection is a good program. It sets a floor under your milk price. It's based off the Board of Trade. The floor is only as good, though, as the market allows. So you can't, if you only have $19 milk and you want to cover $20 milk, you can't do that. And also it's quarterly averaging. So you enroll by quarter, so 3 months get averaged together, and you can only get 95% of the listed price of that put on the Board of Trade. So that also lowers that coverage, often taking us, if we're in that break-even lock-in milk price scenario, below what we really want to cover. LGM Dairy, livestock gross margin, is somewhat similar to dairy margin coverage. It's administered through RMA, and it covers the margins on the futures market between cash settled milk price and a corn and soybean meal price that you put in. It has a deductible $0 to $2, and it's subsidized between 18 and 50%. Right now, this program actually is a risk management strategy, somewhat attractive because it allows you to put some protection or a ceiling on that feed cost, along with locking in those futures markets on the milk price. And we have that really nice margin available right now. So it's one to look at, especially for that over 5 million pounds. So if you want to stay up to date, you can always follow, besides Farm Office, our dairy working group, but our many different social medias that we're trying to keep going. So thanks, everybody.
And Jason, just as a reminder, that program sign up finishes April 29th. So producers need to, here in the next 10 days, visit the Farm Service Agency office, correct?
Correct. If you haven't visited the Farm Service Agency, or if you made a decision and you want to change that, you need to get in there by April 29th. You definitely can't lower it if you already got out your payment, though. So definitely want to get in there and sign up and manage your risk.
We appreciate you being on, Jason.
Okay, thanks, Jason. From here. So today I'm going to talk about strategies to transfer farm operating assets at retirement. And this is an issue that has often come up with clients that I've worked over the years. And The older generation may be ready to retire or cut back, but they still own quite a bit of machinery, livestock, just various operating assets. And the question becomes, well, how do we get these operating assets from the older generation to the younger generation? And it may seem like a simple question, but it is rather complicated to implement because there's various factors to consider. And the biggest issue a lot of times are taxes and how do we manage those? And then also, does the older generation need income from these assets? So those are the two biggest factors that we look at. And, before I get into the different scenarios, I'll just say there's no perfect solution. There's benefits and there are disadvantages to each strategy. So it's really important that before you decide which strategy to use to transfer operating assets, talk to your attorney, talk to your accountant, make sure you understand the implications of the different strategies, and only then should you implement, because if you select the wrong strategy, it can have some pretty adverse tax consequences. So speaking of taxes, what is the tax issue? And this issue comes about for a couple of reasons. First of all, the operating assets are probably going to have low or no tax basis. So if we think of farm equipment, that's all been depreciated out. Livestock probably has little or no tax basis. So if those assets are sold, should generate income for the retiring farmer, we're going to trigger significant taxes. And the biggest of those taxes usually is depreciation recapture. And depreciation recapture is a little bit unique in that it is taxed at ordinary income tax rates. A lot of times we think about when we sell farm assets, we'll pay capital gains tax at 15 or 20% federal rates. But when we sell depreciated assets such as machinery, then the depreciation is recaptured, and that is taxed at ordinary income rates, which can exceed that 15 or 20% capital gains tax pretty easily. So we really need to keep a close eye on depreciation recapture, because that can really cause our tax rates to increase quite a bit and give us a pretty big tax bill. So let's look at some different strategies that we may use. These aren't necessarily all of the strategies, but they're some of the more common ones that I've used over the year, and probably 95% of the time we're going to use one of these to help transfer assets to the next generation. So let's get into a few of the strategies. So gifting, that's the simplest plan, is that the older generation just simply transfers or gifts the operating assets to the next generation. The advantage is it's simple, it's inexpensive, maybe a few pieces of paper. That's about all it takes. And it transfers ownership immediately, which gets the liability of those assets out of the hands of the retiring farmer and into the next generation. And one reason that maybe the retiring generation wants to transfer those assets is they just don't want the liability. They don't want the liability for that big equipment going down the road. So gifting transfers ownership of those assets immediately, transfers the liability of those assets immediately. And then the last advantage is it helps the next generation. If the next generation doesn't have to pay for those assets, they can use their money to buy other assets, buy land, use their money to build the farm rather than buying assets from the retiring generation. Disadvantage, obviously, no income. So if the retiring generation says, well, I need income for my retirement, gifting obviously is not going to be the best solution. And then also when we gift, we don't get a stepped up tax basis. So if the assets are gifted and they have little or no tax basis, then the person receiving those assets are not going to be able to depreciate those. And if they sell them, they're going to have the same depreciation recapture or capital gains issue. But gifting is very common as long as the retiring generation does not need income. So then we have an outright sale. This is where just on a specific day, all of the assets are transferred to the next generation and a payment is made back to the retiring generation. And again, this can still be pretty simple, a few pieces of paper, maybe some titles, depending on what assets we're using, but still relatively easy, can do it quickly without a lot of cost. Advantages, it creates income. So if the retiring generation needs income, this is a great way to do it. It also transfers that ownership immediately. So like gifting, if you just do an outright sale, sell everything all at once, you're absolved of that liability immediately. Disadvantages, tax liability. So if you sell all of those assets all at once in 1 year, that depreciation recapture can really push you up into a high tax bracket, up into the 30+% tax bracket, can really be a big tax bill to pay in that year. And then another disadvantage is it's using up the next generation's resources to buy those assets, and they can't use those resources to build the farm in other way. But outright sale certainly is a valid option. Gradual sale would be where maybe we sell a few pieces of equipment this year, a few next year, maybe over 5-10 years, kind of transfer ownership that way. So the advantages are it creates income again. It does help keep the seller in a lower tax bracket because each year we're selling only a portion. So we're only going to have a portion of the depreciation recapture. It's going to keep us in a lower tax bracket potentially. And it helps the buyer's cash flow. They don't have to come up with all the money at once, helps spread their cash flow out over however many years you do the gradual sale. Disadvantage, we still have tax liability. Might not be as high because we're staying in lower tax brackets, but it's still a sale. There's still going to be taxes owed. It still uses the next generation's cash. The seller, retiring generation, must wait on all of their income. Maybe that's no big deal, but still got to wait on your income. We'd all rather have all of our money up front. And then the selling generation also will continue to be liable for the assets that they continue to own. So gradual sale, we do this quite a bit, probably more so than the outright sale because the advantage of spreading that tax liability usually offsets the additional liability of continuing to own assets. Gradual sale is probably more common than an outright sale. So we can also do an installment sale where you sell all the equipment day one, but then you get paid for it over 5 years, 10 years, whatever it is. Okay, this is usually the worst strategy. And a lot of people don't know about this adverse IRS tax rule. But what the IRS says is if you sell depreciated assets and there is depreciation recapture, all of that depreciation recapture is due in year one. Meaning, even if you sell all your equipment and you say, okay, pay me over 10 years, all of the taxes are due in year one. And a lot of people don't know this rule, and a lot of people get caught by it because you'll structure, then you go in to do your taxes, and your accountant will say, well, you owe more taxes than your first year's payment, on this equipment. So be very careful about installment sales. Probably don't want to do them, but be sure to talk to your accountant before you do it to make sure you understand the implications. So maybe other than gifting, if we're going to need income for the next generation, I would say probably the next most common strategy is leasing with a purchase option. So this is where we would lease, let's say the machinery, we would lease it, let's say for 7 years. And then at the end of that 7 years, give the next generation an option to purchase at the value of the equipment at that time. So the advantage here is it spreads the income out over a number of years. And since it's a lease and not a sale, we don't have all that depreciation recapture due up front. So it's sort of an installment sale type strategy, but it is a legitimate lease. So it spreads the income tax liability. And then it does help the next generation's cash flow because the next generation will make lease payments. That's a fully deductible expense. So it'll help on their income taxes. Disadvantage is continuing to own the assets, and because if you're leasing it, you still own it, and you do continue to have some liability, although you can set up the lease to at least try to transfer some liability over to the next generation. But as long as you own an asset, you have some level of liability for it. Another disadvantage is the next generation doesn't own those assets while they lease them. So they can't use them as collateral. It doesn't show up on their balance sheet as an asset. And the most complicated part of the lease is it's hard to manage trades. So you're 2 or 3 years into the lease, and it just makes sense to trade a piece of equipment in. Well, how do you do that? How do you adjust the lease? Do you buy, a replacement and add it to the lease? Does the lease payment go up? That's the hardest part of the lease, is managing the inventory and any lease adjustments to that lease. But very common to do this. Then at the end of the lease, the next generation has the option to purchase it. Sometimes at that point, the retiring generation will just go ahead and gift it to the next generation, but that's not something we can put in the lease. You can't contract for a gift. So it's not something we can put in the lease. It's not something you can agree to ahead of time. It's not legally enforceable. But if the next generation wants to gift instead of sell at the end of the lease, they're entitled to do that, but certainly not obligated to do that. We often use business entities when we're transferring ownership. So this may be if we're doing that gradual sale, maybe we'll put all the equipment assets in an LLC. And then instead of selling specific pieces of equipment, maybe we'll sell 10% of the LLC each year. That transfer is very easy to do. It's just a piece of paper transferring the 10%. Also, it provides liability protection. So that LLC will trap that liability into the LLC, and so that neither of the owners are responsible for that equipment. So anytime we're doing like a gradual sale or even a lease where we're keeping ownership for a number of years, I'll look at seeing if incorporating an LLC into the plan might be the way to go. Some disadvantages: now you've got an LLC, you've got the cost to set up an LLC, and you've got the management and cost of filing a tax return, having a bank account for an LLC, those sorts of things. But if the transition is going to occur over a number of years and includes multiple people, and having a business entity may be worth looking at. Lastly is the charitable remainder trust. This strategy is different than the others, but I did want to talk about it briefly. This is for people who are retiring but don't have the next generation to farm. This is when somebody wants to retire and just sell their assets outright to the highest. So that's the strategy we're talking about here. But when that happens, we have, very high taxes because we're selling everything in 1 year. Usually we've got a lot of depreciation recapture. We got high tax rates. So for retiring farmers who are just going to sell their operating assets, charitable remainder trust is a good strategy to at least consider. The concept here is you set up a charitable trust, you transfer the assets you're selling, like the equipment, into the charitable trust, and you get a charitable donation for that. So you get a tax advantage on the donation to the trust, and then the trust actually sells all the equipment. So if you have an auction for all your machinery, it's actually the auction flyer will actually say the charitable remainder trust is selling the actual previous owner. So then the charitable remainder trust sells the assets. Because it's a charity, it doesn't pay income taxes. So it can sell those assets tax-free. It takes the sale proceeds, put it in some kind of annuity or investment, and then the original owner, the retiring owner, is the beneficiary of that charitable remainder trust. So the owner gets a annual or monthly payment, however you want to do it, up to 20 years. You pay income tax on those payments, but again, it's spread out. It's not all up front. We don't have all those big depreciation recapture taxes to pay. So again, it's spread out over time. And then when the trust is dissolved, a charity receives 10% of the principal or the sale proceeds. So it also has a nice charitable component to it. So anytime we see farmers who are just retiring and selling their assets and not transferring to the next generation, charitable remainder trust is a strategy worth exploring. There is a brand new publication up on farmoffice.osu.edu that goes into a lot more detail on charitable remainder trust. So if that strategy sounds interesting to you, you might want to take a look at that new publication. So which strategy to use? Well, like most legal questions, the answer is depends. There's no perfect strategy. Each one has negatives and positives, but work with your attorney and accountant to see which one works best for you. And I really make sure you get good tax advice, because the taxes can be enormous when we're transferring operating assets, and it could be a very big surprise to someone if they're not aware of the tax rules and tax liability. So make sure you work closely with your accountant. So hot off the presses just this morning, we have this new publication called Retirement from Farming: Strategies for Transferring Farm Operating Assets. This is available at Farm Office. So if you want more detail of everything I've just talked about, you can pull up this publication and take a look at it. And then there's my contact information. If you have any questions or have any follow-up issues, let me know. Be happy to address those with you. Do we have any questions?
Yeah, Robert, I'll jump in because your talk generated some discussion for sure on the Q&A, but first I want to let folks know that I dropped the direct link for that new bulletin fresh on the Office website into the chat, so it's there. So you have 4 questions. I think couple of them you may have already kind of alluded to, but it's always good to refresh them so we can go back. So I'll read them to you. First, does gifting have to happen to a family member only?
No, you can gift to anybody. Yep.
So they
Does
could-
not have to be a family member or any type of relation. It can be, you know, the hired hand that you want to help out.
Okay, so the next question is, so that's the first one. Does the related buyer get a new higher tax basis with the sales option?
Yeah, I think the buyer's going to get a new basis of the purchase price when they purchase it. Now they can't, David, maybe you can help me on this. They're not going to be able to Section 179 expense it, but they will be able to depreciate it. So yes, get a new basis on a purchase.
Okay, and then this question was asked before you went into the business entity discussion, but we'll revisit it. If assets are owned by an entity, why not transfer percentage of the ownership?
Yeah, so normally we would do that, although if the retiring generation maybe wants to keep a few pieces of equipment, they want to keep the bush hog and the tractor with the front end loader, maybe we'll transfer the assets out of the entity and then transfer the assets to the next generation. But yeah, generally, if those assets are already in an entity, we're going to transfer ownership of the entity, not the actual asset. That is correct.
And you described that on how to do that as you spoke there. So the final question is, if you are leasing the equipment, can the user claim any parts repairs for the equipment on their taxes, or are the repairs still a responsibility of the owner?
Yeah, great question. I should have addressed this. So Heather, thank you for bringing this up. When we do leases of machinery, we usually do triple net leases so that the next generation, the farming generation, they are responsible for insurance and repairs. That just makes it easier. And also the next generation to make the repairs themselves. It's easier. It's a deductible expense for them. So usually on the lease, the user, the next gonna pay for expenses and to be able to deduct those expenses. Yeah,
Okay, question is, what
what
about transferring land?
Yeah, you did notice I didn't talk about land. To me, land is completely different asset. I'm not a big fan of the retiring generation transferring their land. The reason for that is land is pretty low liability, pretty low management. Also, it's going to hold, to me, it's the retiring generation security blanket. And so normally we want to transfer the operating assets because those are going to depreciate, wear and tear. They're going to need repair and high liability. But your land is kind of just the opposite. It's not going anywhere. It's probably only going to increase in value. So that's why, I called it operating assets and not all assets. So typically we keep the land with the retiring generation. For those reasons, also, when the retiring generation passes away, we get that stepped up tax basis too. So yeah, generally, I'm not a fan of transferring land during life unless they really need the sale proceeds from it. It also creates a nice cash flow too from the rent. Good question. All right.
So that's all the questions that are in the Q&A there for you, Robert. But
Okay.
folks here are hearing it first. This is a brand new publication, so it's online today for folks to access. So I encourage you to go to the Farm Office website to be able to download that, or you can get it right out of the chat box.
Yep. So, okay. If there's no other questions on that, it is my privilege to bring in Tim Harpster. And Tim, are you here? I see your name. Can give you a minute to jump on here. You may be muted if you're trying to talk.
Well, can you hear me now, Robert?
There you go. I can hear you
Okay.
loud and clear.
Oh,
So
good. I got, good morning. I got my camera on. I'm not sure why I'm not showing up. I even clicked here on start video. But, oh, there I
there you
am.
go. There you go.
Okay. Yeah, glad to be here. Thanks for asking me.
Yeah, really appreciate you having you on and taking time out of your day. Just a brief introduction. Tim is with Consolidated Appraisal, and I don't know if you're the owner, but you're certainly one of the owners of Consolidated Appraisal out in Wapakoneta. And Tim, I'll let you talk a little bit about your company, but I do want to say I've worked with Tim for a long time, and anytime I had an appraisal that was kind of tricky or unique or hard, or I thought might get challenged, and I wanted to make sure if somebody had to back the appraisal up, they could do it, I'd usually call Tim up. And Tim has always done a great job and done it in a very timely manner. So if you need an appraisal, give Tim a call. They do a great job. But Tim, do you want to talk a little bit about your organization? I know you cover the whole state, right? And maybe some of the different services you can provide.
Oh, sure, Robert. And thank you. Those are very kind words. I did my first appraisal in 1987, so I've been around a year or two. And Bill Wilkins and myself started Consolidated back in 2003. And today we have about a dozen active appraisers on staff, and we cover all of Ohio, Indiana, and one of our appraisers is even licensed in that state up north. We've appraised in quite a few different states, and I think of the 88 counties here in Ohio, in the past year or so, we've probably been in 70 or so of them. So we have a pretty good footprint. Appraise everything from unimproved land, all to a lot of confinement livestock, hog barns, dairies, grain elevators, feed mills, and also we have a commercial division that does a lot of the basically the mom and pop stores and industrial facilities. So we do quite a few different things. The things we don't do would be like the downtown high-rise buildings, things like that.
Okay. This group is pretty heavily focused on the farm side of things. So just wanted to ask you maybe in the last 10, 15 years, land prices have really skyrocketed. What have you seen? How has that been a challenge to you? How does it affect how you do appraisals? Where do you see this going?
Yeah, the one thing that's really changed things is when Intel and Microsoft announced their presence in Licking County, that just rippled out through the state, and we're seeing people selling land there in Delaware County and on the west side of Columbus, and they're moving out several counties, and that's affecting us up here. And then the people up here are just trying to compete with that, and that's really affected things. One major difference from years ago is that when we would do an estate, the estate might be 40 acres or 60 acres or 100 acres, and today it's 500 acres or 1,000 acres. I mean, it's just the fewer estates that way probably for us, but the estates are bigger. So land prices, like I said, of course, everybody knows have increased substantially. A little difficult staying up to date, but sometimes at certain points in the cycle, there's fewer sales. But as long as we stay fairly current, and technically we can go back 5 years, that's a long time today to go back. As long as we can stay within 6 months or so, we generally tend to be pretty much up to date.
Okay. Something I've always kind of wondered about, because I get these comments quite a bit, and a client will need an appraisal, and I'll say, hey, call Tim, you get an appraisal. And the client will say, well, should I tell him to make the appraisal high or low? You know, and I say, well, the value is what it is. But could you talk about like what does it take to be I don't know if you call yourself a certified or licensed appraiser, maybe talk there, but what is your accreditations? You know, what ethical issues in the legal field, we talk about ethical issues all the time in the appraisal world. What are your ethical issues? What can you or can't do for a client who kind of oversees your profession?
Sure, yeah. When we're functioning as an appraiser, a lot of times we're the only party in the whole transaction that is impartial. Well, we're supposed to be impartial, independent, and objective. Professionally, we don't care if the deal gets done or not. That's not the case on a personal level, of course, but you know, in any transaction, be it somebody's going to selling a farm, they want their deal to get done. Maybe the realtor's involved, auctioneer, they want the deal to get done. The lender wants the deal to get done. The buyer wants the deal to get done. And technically, the appraiser is supposed to be the only one that, well, you know, it is what it is. As far as setting tax bases or for an estate, we have to maintain our impartiality, our independence, and we are overseen by the Ohio Department of Real Estate. It's the Ohio Department of Commerce Real Estate Division, and we're governed by a fairly complex set of standards. You guys won't remember this, but it's Uniform Standards of Professional Appraisal Practice, or USPAP, and it sets pretty high standard for being independent. Quite a few of the people that we work for, they do say, hey, you know, if you could be a little generous on value, we'd appreciate that. Or if you could be a little conservative on value, that'd be good. And we just have to ignore that. And we do some litigation, and those are always interesting cases because you can tell who wants to keep the farm and who wants to sell their interest. And the person who wants to keep the farm, well, you know, it's one of the worst farms in the county. And the people that want to sell the farm to whoever, was one of the best farms in the county. Right. So we over the years, you've got to become pretty immune to that.
Okay. One thing I think I've always thought is unique about being an appraiser is you have to do is it a 2-year apprenticeship? Can you talk about that? Why does your industry have that when I don't think a lot of other places do?
Yeah, it's a fairly intense apprenticeship. You have to have a 4-year degree now, and that's been the case for quite a few years. And you have to have 3,000 hours of practical experience. It's 300 and some hours of classroom time. And I've developed quite a few appraisers over the years for our staff, and it is a fairly lengthy process to get somebody, because it's a kind of a totally different way of thinking, and you got to develop that immunity to people trying to influence you one way or the other. And now you can go on the one of the appraisal societies I'm a member of has a lot of education, and they accredit people. I'm an accredited rural appraiser, and that's just further education. So it is a fairly lengthy process.
Mm-hmm. So let's talk a little bit about some appraising specific things. Maybe we get the occasional call of somebody's got a barn or a building that's sitting empty and somebody wants to rent it, and they call, well, what should I charge for this thing? How do you go about valuing agricultural buildings, particularly maybe old freestall barns that don't have cows in them anymore, or at least don't have dairy cows in them anymore. Is that I'm sure it's a challenge for you, but how do you overcome that?
Yeah, those empty barns can be a challenge to value. You search a large enough area for sales, we're bound to find some. So we just, it may not be in the same county, but generally if we look around and search, we can find sales. Grain elevators are a good example. About 25 years ago, we would appraise the small country grain elevators, and sales were easy to find then because the transition to consolidation had started, but it hadn't finished like what it is today. Whereas today, if we try to do a grain elevator, a small country grain elevator, those sales are a little bit more difficult just because there aren't near as many as there used to be. So there's far fewer sales. The empty freestall barns, empty dairy barns, we generally survey farmers, and we keep a pretty good database between all our appraisers here, and we're able to draw on that. But basically, rental rates will come from surveys where we will visit with the owners, people that maybe will rent barns out, and whenever we run across a barn that is rented out, we of course put that in our database. There's several large steer feeding barns across Northwest Ohio now, and the first one we got, was rather difficult to do, but after you do several of them, we've been able to develop our database, our sales that are out there, and we're able to come up with what we think is a valid market opinion of value.
Mm-hmm. When I get an appraisal back and I'm kind of skimming through it, see what the values are, a lot of times it'll say, if it's land, it'll have an income-based value and a comparable sales value. I kind of understand the comparable. Did you talk about, do you have to use income in your appraisals, or in which is a better indicator, income or comparable sales? How do those work together? Or
yeah, there are basically three approaches to value, or three standard approaches to value: the sales, the income, and then the cost approach. If we're doing like a new hog barn, we'll have the cost, so we'll do the cost approach, because we'll have, you can appraise the land as it is, and then we know what it's going to cost. So if it costs $1 to build something, and then land and everything, then unless the market's discounting it, it should be worth $1, and we'll have sales to back that up. The income approach is kind of, it's a test of reasonableness as much as anything. We will base our opinion more on, for income approach, more on strictly income producing properties. Like if we're doing a leased fee, say a Wendy's restaurant or a Burger King or something, whereas on the farm, the income approach, the capitalization rates we're using, or that we're seeing on farms, are so low. You're talking 1 to 2% as a capitalization rate, and I won't go into what those are, but most of you guys probably understand that. But you go from 1 to 1.1% on a cap rate, and if you got any number of acres, that's a pretty good swing. So there's a huge room for error on that. So what we'll would rather do, and especially if we're taking something for litigation, the sales approach is normally the best way of doing it, just because you've got, say you're appraising an 80-acre farm. As long as you have several sales that are similar enough, with similar physical characteristics, such as the soil types and the terrain, and possibly tiling, access, same market, then if you got 3 farms that have sold for ranging from 98 cents to $1.02, you know, chances are pretty good that as long as you're within that range and you pick one that is most similar to your subject at say $1 or $1.01, then you're going to be pretty close to market value.
We got a question that came in. Can you briefly discuss the factors used for appraisals involving the sale of development rights? So conservation easement,
conservation
ag
easement.
easements. Mhm.
Yeah, and we do a fair number of those across the state. And those are probably some of the most complex appraisals that we do, because what we'll do, again, let's take the 80 acres and we will appraise it today as it is, fee simple. The development rights are there, the bundle of rights are intact. So that's the easy part of the appraisal. So then what we'll do is we will find 3 to 5, as many sales as we can of properties with conservation easements on them. And of course that's not going to come from the same county, because there's just not that many to begin with. So we do a fairly wide search. And when we find those, what we have to do then is basically appraise those. So let's say we have a sale in say Glades County, it's got a conservation easement on it, and we're doing an appraisal in say Hancock County. We will look at that property in Glades County and say, okay, it's got an easement on it, and we've got 3 to 5 bare land sales around that property that sold for $1, and the property that sold with the easement on it sold for say 80 cents. So from that sale we can develop a abstract from the market, a discount of 20% or 20 cents, a diminution of value, and we'll do that for however many sales we're able to find. And so we go back to that original 80 acres and apply that 20-cent discount, and then we'll end up with what the difference is the before situation minus the after situation once the development rights are given up, and that's what the development rights are worth, because people don't buy and sell easements. I mean, ideally, in an ideal world, we would be able to find sales of easements, but that just doesn't happen. And say if you were in Licking County, of course, that easement difference is going to be substantially more than it would be here in Glades County where I'm at.
Right. Sounds like this appraising stuff's hard. I don't know. Glad I stuck to being an attorney, not an appraiser, I guess. So
Well, we just have to be able to defend it.
yeah. I got 2 more questions for you. One is, when you do an appraisal, are you able to, I don't know, ignore outlier sales? So, you know, there's a 40-acre parcel and it's right between the 2 biggest farmers in the county, and they both have to have it. And, you know, they pay a ridiculous amount of, that price is ridiculous on it. Are you able to say, well, that's an outlier, we're not going to use it? Or are you obligated to use it because it's an arm's length transaction?
Well, I think that'd be a situation where you have what we call super motivated buyer. And there's an auction over in Mercer County that every time I'm over in Mercer County, people tell me about it. You know, it sold for $30,000 an acre.
Yeah.
Well,
Right.
It did, but it's only 20 acres.
Yeah.
So everybody wants you to use that one. And that's really difficult to use because that is an outlier. 20 acres and one sale doesn't make a market. That's why we try to look at least 5 to 6 sales, and we'll base our opinion on 3 to 5. something reasonable. It's not reasonable to use an outlier, either high or low.
Okay,
So yeah, we try to, that's the reason we use a number of sales.
okay. Question came in, what is the best way to factor farm management style into an appraisal? Example, 30-year no-till versus 30-year conventional. Does that factor into your method?
It does as much as what the market does. And I know that's not much of an answer, but it's kind of like tiling. You know, I get asked that question a lot. Do you value tile? And well, we do, but just to the extent that the market does. And with $10,000-$15,000 land, I don't know what's it cost to put to tile land today. Is it, you know, $1,500 an acre?
Yeah, probably.
So that kind of gets lost a lot of times, especially when you have differences, especially when you have sales from say 12,000 to 16,000 in a market, that $1,500 kind of gets lost. It's kind of like the 30-year no-till versus the 30-year conventional. You know, that's, yeah, is there a difference? Yeah, I would think there'd be a difference, but good luck abstracting that from the market. And you know, market people can tell you, yeah, that, oh geez, you know, it's worth $1,000 extra to me. Well, you know, okay, but what we measure is the what we call a typical buyer, and that is just the aggregate of everybody's reaction in the market. So it's not any one specific person. It's a measure of what the typical what the aggregate everybody in some does, their reaction to various things.
Okay. My last question, I know you've been pretty involved with the Society of Farm Managers and Rural Appraisers. You want to talk about that group a little bit and what they do,
Sure, yeah.
who's involved with it?
Yeah. Started in 1929, the organization did. And so we'll be celebrating 100 years in 5 years from now. We have members across the country, a couple different countries, I guess. But here in Ohio, we have about 56 members. And the society has farm managers as well as rural appraisers, and does just excellent education. We do invite anybody that's in agriculture to attend our meetings. They're very, very interesting. Farmers, people in lending, attorneys, just everybody's invited. It's a just a good group, and even though it's a society, you really, I mean, you go there for some social aspects, I guess, but it's really more for the information and education. And it's a good society. It's a good organization.
Yeah, and we've put the link to the website there in the chat if anybody wants to take a look at that. And yeah, I don't know how many people are involved with that, but there's a lot of appraisers and farm managers all over the state, I know, involved, and you can find them at that website. Any other questions? Any of the other panelists have any questions for Tim before we let him go? Okay, it looks like that somebody raised their hand. David, I'm not sure what to do with a raised hand. Is that
Right.
Teresa, do you have a question? Do you want to?
Be great. Or in the Q&A.
Yeah, if you could type that in the question and answer box there if you have a question.
My only question, Tim, would be, if someone is looking for an appraiser, or there's some appraiser to hire an appraiser, or there's some tips, and just like hiring an attorney, there are, you know, questions that you might want to ask. So are there certain questions that we might want to ask as we're asking the appraiser their experience? And then on the second part of that, what could be and I don't want you to give like a specific, but what kind of a range and price does it cost for an appraisal when you get into different things like an LLC shares issue or buildings or land?
Yeah, questions to ask an appraiser, experience, background. I mean, do you have any farm background before appraising farm ground? A lot of times that's, especially buildings. I mean, do they know what a bore is versus a barrow? You know, things like that. What's a gilt? What's those big blue tubes for? What's those big steel cans for? You know, if you get somebody like that, you probably got the wrong person. But I grew up on a farm. Actually, I still live on a farm. I got 3 brothers, 2 of them farm, and I guess we all own some farm ground. Does the appraiser ask questions, or is it just, hey, I got 80 acres in a barn, I need you to appraise? Well, you know, if they don't ask, well, geez, is that, tell me about the barn. Is it, and it could range anywhere from an old 40 by 60 post and beam barn to a 5,000 sow, hog farm. So they need to ask questions. Does the appraiser give you a written proposal up front? We always give a written proposal for non-lenders. It's got we'll put the farm maps on, and we'll put the fee on, so that you know that we know what we're appraising, so we don't appraise the wrong property. Because well, it used to be we would get calls, say, hey, I need you to appraise 40 acres there. It's right at the corner. You know what it is. It's right at the corner there between those two, where the 2 roads meet. And that's difficult to find that sometimes. So we do use a written proposal. Are they, of course, licensed, certified? Are they in the state? Are they accredited? So much of it depends on what the appraisal is going to be used for. Fees, bare land typically starts out at say $1,400 or so, and if we're doing a large dairy, it can be as much as $5,000–6,000 or so. So they really range across the board, and we try to be pretty specific on quoting per property, so that we tailor the quote to a specific property.
Tim, if you got another minute, we got a question, and then we'll let
Yeah.
you go. It says, doesn't a seller want to sell to a buyer who is willing and able to pay a higher price based upon buyer view of the value, for example, tile versus average view? So I guess maybe it's back to that you were talking about, is, you know, how much does the tile affect the value?
It would seem that way, Robert. My experience has been we don't make the market. An appraiser does not make the market. The appraiser just reports the value, an opinion of value, an informed opinion of value, as of a specific snapshot in time. And so over the years, I have seen several farmers will buy a particular farm, and perhaps it was just pretty well tiled 5–10 years prior, and the first thing they do is go in and retile it. Mm-hmm. So, I mean, farmers, we all suffer from this, that whoever was before you didn't do a real good job, and they don't do the same type of job as what I do. So, geez, I mean, they just made a mess of it. So we're gonna, I'm gonna do better. So they'll go in and they'll retile a farm that was just done 5 or 10 years prior. So does the market pay for tile? Yeah, it does. But when it is when it is a small percentage, and again, let's go back to that $12,000 to $16,000 acre range, $1,500 for new tile kind of gets lost in the rounding. I mean, it's valuable, it's there, people pay for it, buyers want to be compensated for it. But if you can't abstract it from the market, then perhaps it's real difficult to value. Now, the thing will be is if somebody says, hey, that this was just systematically tiled, and we went from, let's say it's a heavy clay soil, we went from 40 feet to 20 feet. And we did it a year ago. But instead of being towards the low to mid range part of the range, maybe the opinion of value ends up being from the mid to higher part of the range. So the tiles in there, it's just not a line item thing to discount or pay a premium for, to adjust for. So yeah, and one thing that hasn't come up is wood lots. Wood, of course, there's not a whole lot of wood lots, in this part of the state, I guess. But we value wood lots also. But yeah, the tile's in there.
Okay. All right. But Tim, my farm's in Coshocton County, and I have both wood lots and tubes you were talking about. So come on over and we'll figure out how much you're gonna value those harvest stores for. But
Okay, sounds good, Robert.
0, I would guess. Well, Tim, thanks for having us, or thanks for being on with us. Very valuable, great insight into your profession. And we all work together on this, and appraisers are a big part of the farm management team. So thank you, and thanks for joining us and all that helpful, useful information.
Very happy to do it.
Okay, thank you.
We appreciate you being on. And before we close, I want to say that we did have a comment in the chat box from our friend Jay Craig over at Penn State asking about the Farm Bill update. And just to let you know that we are watching, you can see on the screen that we're going to take a pause here from Farm Office Live, as we usually do during the growing season, but we'll be back live at the Farm Science Review to kick it off on September 19th. But I'll bring back the Farm Bill discussion because we understand that the Farm Bill is out there. We're monitoring this, which means as Farm Office Live team, we will be watching, monitoring, and as issues come up, and it could be issues outside the Farm Bill, be watching your email box because we may be holding special editions from here through September on some of the hot topics of the day, depending on what those may be. So the Farm Bill, of course, is something that's near and dear to all of our hearts, something that we're watching. I see a nice article, which will drop in the chat here from our friends at Farm Doc this morning with indications that it looks like the House may have their markup by Memorial Day here. And then that will allow some of that discussion. I know the Senate said that they don't want to start that discussion until they see what the House is marking up. But we know it's going to be a little bit of a push to get a Farm Bill through this year, as from many of the prognosticators that, especially in an election cycle, that this might not hit the into the discussion phase until after the election. So we're watching it closely, and then we'll be adding to that. So thank you, Jay Craig, for that question. And a reminder for the dairy farmers that are on today's call, or those that work with dairy farmers, if they're going to enroll in the dairy margin coverage program, they have until April 29th to get that done. So with that, one last thing that we have for you, as always, we appreciate your responses to our survey. We do look at these, and that helps us craft our discussions for our future Farm Office Live webinars. So I'm putting in the chat right now how you can get and access that Farm Office Live evaluation. If not, you would expect to see an email from Jeff inviting you to do that later as well. So with that, team, are there any other questions that I missed? All right, with that, we thank everyone for being on. And again, if you want to go back and rewatch the webinar, just go to farmoffice.osu.edu/Farm Office Live. You'll be able to see this production as well as our past productions as well. Thanks for attending, everybody.